I was just doing the overview. So thank you and welcome to today's class. So yes, yesterday we saw that mean is affected by that is the outliers. Okay, and if mostly our data set is symmetric meaning we don't have that is outliers. Okay, yes, no major outliers. So the data it's close to the data points are almost close together. Okay, meaning there is no data point which is far away from the others, but we can say they are clustering in the same area. Okay, so we can say that the mean of the value, all the mean value is located exactly at the center of what? Of those data points. Okay. However, in skewed distribution, the mean value is pulled away from the center. Like yes, I can remember yesterday I gave you an example where we introduced some outliers. Al that is an extreme large value, and also we in that is we added an extreme that is low value. Okay, and you saw that whenever we added that is an extreme large value. Okay, the mean was moving towards what? The mean was moving towards that large value. Okay, and when we were that is we introduced or we injected that is an extreme small value. Okay, the mean that is tends to move towards what? That small value. Okay, yes. So if you can remember, like for example, you can see in the example above. Okay, we've now introduced what? We've now introduced 88. Okay, as an outlier, and you can see the mean has now moved to what? To 45, meaning it's growing towards what? Towards that is that value. Okay, so just to that is to conclude on the measures of central tendency before we go to the measures of variability, we can conclude and say that mean is the preferred measure of central tendency when the data is normally distributed, and not just normally, it is like perfectly normally distributed, like we are having a symmetric what? Distribute that is a symmetric distribution. Okay, yes. So with that, at least we can say that mean will be preferred, that is a measure. Okay, then median is the best measure of central tendency when the data is what? Is skewed. Okay, so when the data is skewed, so we usually say that the median is the best measure. Okay, in that case, while dealing with nominal variable, the model is the best measure of what? Of central tendency. But the good thing is that when you want to use measures of central tendency to make a conclusion, then you need to combine all those what? All those measures for you to make what? To make that is a good conclusion. Okay, just a conclusion, we can say that mean, median, and mode are the most important measures of central tendency. The complete data sets may be represented by these values. It is not necessary for mean, median, and mode to have the same value. Take note of that. And we've said that mean is sensitive to extreme data values. Okay, it is not wise to take mean of the skewed distribution as the true representative of the data set. Then median is better way to understand the skewed distribution, and mean and mode can never be what? Can never be zero unless all the values are what? Are zero. Okay, but mean and median can never be what? Can never be zero. Okay. All right, now let's go to measures of variability. That's our today's class. Okay, of course I had given you I had given you um, that is an assignment, not an assignment to do, but I told you to go and research about variance, or what does variance really mean in layman's language. Okay. Yes. So now it's your time to know if you did that. So I would like volunteers, okay, to make us understand what is variance, okay, what is standard deviation. Yes, please. Someone, someone. Yes, Mustafa.
Uh, in fact, it's a bit mathematics. I mean, to describe it verbally or orally, it might be a bit tricky, but I'll try.
Hmm.
The,
Maybe
the,
you can come closer to your mic, unless maybe it's my volume. In fact, it's my volume. Let me check my volume, please. All right. Sorry for
so
that.
for each observation, we shall get the mean for each observation.
Hmm.
Then we square the mean after getting the mean of each observation. We do subtraction. Uh, then we do the square root of the results. This will bring the variance, and then standard deviation is the square root of the variance.
Okay.
I'm not sure whether I was able to explain it or not.
Of course, you've tried. You've tried to mathematically explain it. But let's assume maybe you've gotten a variance of 20,000. Okay. How can you explain that value to your client? Client has no knowledge in statistics, but he wants to understand what is this value, what does it mean. Okay.
It is more or less the spread between the observations in our data set.
Okay, you now come in closer to what I need. You are
Okay,
now coming closer to what I need.
okay.
Yes.
Thank you.
All right. Thank you. Someone else? Yes, Mohammed.
I would say it's the extent of deviation from the spread of the data set.
Come again. Come again.
The extent of deviation
Uh huh.
of from the spread of the main data set.
Okay. Okay. All right. All right. Yeah. So maybe yes. Yes, Anton.
From my end, I can say that variance refers to how far a number is from the mean.
Correct. How far or how spread is our data set, okay, that is our data points away from the mean, okay. Like for example, I can just give out an illustration, okay. Let me try an illustration. So let's assume we have this. I'm just assuming we have a point here, like I'm plotting the mean, okay? All the coordinates of the mean of our data sets, okay? And I'm having kind of cluster. That is, my data points are what? All right. My data points are that is close to the what? Close to the mean. I'm just trying to illustrate. Okay. So basically, variance tries to show us, okay, how far our data points, okay, these are the data points, how far are they from the what? From the mean. Okay, either in positive or in negative what? Direction. Okay, so I'm assuming this is my mean. It can even be that is not this kind of that is what do I call scatter plot, but it can be also something else. Okay, another kind of what? Scatter plot. Okay, and we want to check how far is our data points. Remember, these are our data points. Let's assume you are given this set of data points. Okay, we have x and y, and you are now to plot them in this manner. Okay, then do their mean and do what? Plot the mean point. Okay, of this data set, meaning you are going to find the average of the x's and the average of the y's, and that mean point you can plot it on what? On this diagram. Okay, so that is the first maybe that is data set we are plotting, and maybe you also get another data set which looks like this. Okay, which looks like this. All right, which looks like this. So basically, we'll say that we'll have a small variance here. We'll have a small variance, that is the distance between the data points, okay, or the accumulated distance between our data points and the what? And the mean will be what? Will be small here, okay, compared to this, because you can see at this illustration values are what? Are far away from the mean, like they are scattered away from the mean, meaning in this case the distance between what? The distance between the data points and the mean will be what? Will be high. Okay, that's why when we are talking about the variance, meaning the difference, okay, the variance, the delta, if I can say, or let's say the variance. Okay, here you can see that is from even the formula we use for to calculate variance. We usually take maybe the the xi's, okay, values minus the x bar. Okay, like for example, let's assume we are working with only one data set, okay, set of data, and we want to find what? The variance of what? The variance of maybe x. Okay, we usually say it is 1 divided by n minus 1 multiplied by summation of xi's, okay, minus what? Minus x bar. This is for sample variance. Sample variance. Okay, we usually have what we call sample variance, okay, denoted by s squared. Okay, so basically we know that is the variance by the definition. Sorry, here we usually we usually square the difference. Sorry guys for that. We usually square the difference to make it a positive, or to make it an absolute value. Okay, so I will come to explain why we divided by n minus 1 and not like the variance for what? Not like the variance for the population, where we usually have 1 divided by n summation of xi's minus what? Mu, okay, squared. All right, so basically I was just explaining the term variance. It is trying to show us the what? The squared distance between that is a data point to what? To the mean. Okay, that's all about variance, and we usually say the that is the larger the variance, the more our data points are far away from the what? From the mean. And the small the value of the variance, okay, the closer the data points are. Even when it comes to correlation, okay, if we have that is a very minimal variance, then it will mean these data are highly correlated. Okay, if the data points are far away from each other, it might mean they might not be correlated in what? In any that is in any way. Okay, but we shall check that on the next topic when we will be discussing about the correlation and covariance. Okay, I don't know if that point that is as sunk well. Let me admit someone. Yes, Mustafa.
Kindly, why it's n minus 1?
Okay, good. Maybe before I can answer, can someone maybe try, give it a try? Why for that is sample data? Why is it n minus 1 and not n as that of population? It's very simple. Someone? Okay, good. Let me explain it to you. I will just first of all write the two that is the two formulas here. Okay, so we have what we call sample what? Sample variance. Sample variance. Okay, and sample variance is denoted by S squared. Okay, we also have what we call sample mean. I guess I explained this in the last class, and we said the sample mean is denoted by what? X bar. Okay, then we also have what we call sample standard deviation, st dev. Okay, standard deviation, and this is denoted by what? S, that is only S value, sample variance S squared, sample mean this is mean, sample mean X bar. Okay, then population variance is denoted by what? S sigma squared. Okay, and we have also population mean, population population mean, okay, is denoted by what? By mu. And then we have what we call population standard dev, okay, or standard deviation is denoted by what? By sigma. Okay, it's denoted by sigma. Good. This is something you should know, so that maybe when you see that is in a question, please calculate what? The population variance, or calculate the what? The sigma squared. You know you are asked to calculate the population variance. If you see mu, you know it's population that is mean, and sigma alone you will know that is population standard deviation. Okay, what is this population? Okay, what is this population and sample are we talking about? Okay, like for example, which tribe in Kenya do we associate with heightness? Like their heights are like they are tall. Okay,
The Masai.
yes, the Maasais. Okay, we usually assume they are tall. Okay, but not all Maasais are tall. You want to maybe do an hypothesis for that. So our null hypothesis shows that we have a significant difference. Okay, so if we were to do an hypothesis for that, okay, then our H naught, don't worry, I will take you through the hypothesis testing. Our null hypothesis will say that we have a significant difference between maybe the Maasai's, that is Maasai'ite, and maybe another tribe, okay? And then the alternative hypothesis will be that is exists no significant difference. Like for our case, we want to do an analysis to see, is it true that the Maasais are always what? Tall. So we know Maasai community, let's assume the Maasai community has a population of let's say 3 million. Okay, we have 3 million Maasais in Kenya. Okay, so our population which we are trying to study, it is what? It is 3 million. So the whole population of the Maasais, we are saying they are having an head count of what? It's an head count of 3 million. Okay? But you, as an analyst, even if you are going to do what? To do that survey, okay? Of course, you cannot cover what? You cannot cover the 3 million people. Now you might opt to take a proportion of the 3 million people, okay, to take what? To take their measurements. So let's assume you take what? You take a sample of 1,000, okay? Meaning you will take only 1,000 Maasais from the 3 million, okay, to act as what? As your that is a sample, okay?
Test.
Yes, that is as your sample test, okay, or as your sample size, okay. So in this case, we are talking about sample and not population. And remember, sample gives us information about what? About the population, okay. And we know that try not to confuse you, but we'll come to look also at the what we call a theory of estimation. Like the more sample you have, the more informed you are about the population. Okay, or if we were to increase the sample size to 10,000, from 1,000 to 10,000, we would get more information about the population. Okay, so basically for this case, we have assumed that the 1,000 is sufficient, that is a sample size, okay, to do what? To do our sampling or to learn about the population. Okay, so the population is the entire that is a count you are trying to study, and then a sample is a proportion of the population, okay, which you are trying to do what? To maybe study about. I hope under population and sample we are clear. Okay, good. When it comes to sample size, okay, when it comes to sample size, we usually say that is the sample size, it's denoted by what? By n. And population size is denoted by what? By p. Or sorry, sorry guys, it's denoted by n, capital N. Sample size is denoted by small n. Population size is denoted by what? Is denoted by capital N. Okay, so meaning if we were to find the variance of the population, okay, variance of the population, we would say it is what? 1 over the entire population, okay, multiplied by summation of what? Okay, or the summation of the difference squared, okay, the summation of the xi's minus the x bar. Sorry, this is population. So xi's, they are what? They are our that is count minus our mu, because we are talking about population. So we are talking about that is the xi's minus the mu, which is the population mean, okay, then squared. This is for what? Variance for population. Okay. What about the variance for that is for sample data? Okay. So variance for sample, we usually take now 1 divide by what? By n minus 1. Meaning n minus 1 is a sample, even if it is only one person to the whole population, okay? But we are trying to take what? To take the maximum, that is the maximum what? The maximum number of the sample we can take, okay? So that's why we usually divide with what? With that is with n minus 1. It's like saying the population, it's what? Population size is 1,000, okay? But we can have a sample or our maximum sample, okay? That is our maximum sample size, which is n. This is the capital N. Population sample, it's 1,000. So our maximum sample size, it can be what? It can be n minus what? It can be n minus 1. Meaning it will be what? Our maximum sample will be 1,000 minus what? Minus 1, which is 999. This is also a sample, okay? But it is the what? The maximum sample which we can take when it comes to what? When it comes to this, okay? I don't know if Mustafa that's clear now. Why we usually take n minus 1 for sample size instead of 1 minus n. Mustafa, maybe you're on mute.
Yes, it's okay. It's clear. Thank you.
Okay. All clear to the others? Maybe by the show of thumbs up. If you gotten it clear, thumbs up, please. Good. All right. Nice. Let's now continue. So, I guess we are done with the definition of variance. We've really exhausted it. Okay, so we've said that. Let's come now to our notes and see what that is variance will be. Then for the standard deviation, before we can start maybe going through the slides, the standard deviation, of course, we know it's the square root of variance. Okay, but for standard deviation, okay, it tries to show us that is the minimum value of deviation, okay, like the minimum value of the deviation, or the general deviation between what, between our data points and the what, and the mean. And we'll also come to see it shows it tries to show us like the consistency of maybe of our data, okay. Yes, so we will learn more about it. So let me start on measures of variability. So for the measures of variability, for the measures of variability, we have variance, okay, and under variance, we want now to define that is the term what, the term variance, okay. Yes, just a minute. All right, good. Let's continue. So, variance, we've said that the term variance refers to a statistical measure, okay, of the spread between the numbers in a data set. More specifically, variance measures how far each number in the set is from the what? From the mean. and that's from every other number in the set. Okay, so like the illustration which I gave you here, like it tries to show us how far, okay, how far those values are far, okay, how far the data points are away from the mean, okay, away from the mean, you can see, and also away from what, from each other. Okay, so basically variance tries to show us the spread, okay, or the distance between one value to the other, okay, in a data set. So variance is often depicted by that is the symbol sigma squared, and this is for population variance. Okay, and it is used by both analysts and traders to determine the volatility and that is the market security. Or it basically shows us the volatility of market securities. Okay, like if the variance is very high, okay, we know that is the volatility will be what, will be as well, that is high. Okay, like meaning, like whenever we have that is a very large variance, then it means that is our data points are far away from what, they are far away from each other. Okay, and you can imagine if those data points were prices of maybe a certain that is shares. Okay, and we have a drop in that is in the price of that share. Okay, like one drop, you can see any drop will bring that is a very high impact. Okay, in terms of because the if the variance in terms of the prices is high, then one drop in one variance, you can what, you can suffer that is large losses. Okay, but if maybe you gain, okay, if you gain, then of course now you will or if the prices goes up, okay, then it means you are going to what, to get your money well. Like for example, we have these cryptocurrencies which people usually use to trade. Okay, like if I don't know, maybe I was just checking something with of course my friends, like World Bank, not World Bank but WorldCoin, uh, last in the beginning of this month, the WorldCoin price or the WorldCoin value was around 300. Okay, it was around 300, but right now as we speak, few days, okay, the WorldCoin has grown, that is in terms of price, greatly. It's currently trading around that is around 1200. Let me confirm, around 1200. Okay, let's try and see this. Okay, world coin current price, don't know if we can see it here. This it seems it's we can't get, okay, we can't get its value right now. Its value is currently at this US dollars. Let's take that is USD to Kenyan shillings. So it is currently at 8 US dollars, 8.6 US dollars. You can see it's currently around 1200, 1257. Like you can see the increase in the value around 39 point, you can see how it's going up. Right now it is at 40. okay, growth. So you can see the way it has what? The way it has been fluctuating, okay? This was at what period? Let me check. This was today, 22nd, at 6:52, okay? Right now you can see where it is. It's already up. No, right here. You can see it's already up. Going up, you can see now it has changed. It has gone to 40.83. So, like that kind of volatility is what we are speaking. Like if now we have maybe for this February, okay, we have high variance, okay, between what? Between those maybe different prices which which we can collect, okay. You will get that we will have a very huge variance. Like for example, if we were to get the hourly interval prices since maybe yesterday up to now, okay, hourly price interval, you will find that at some point that is the values or the and try to plot that price that is the value, okay, all the prices, you will find that those values are far away from each other, or basically we'll see, or you'll get a variance value which is very large, okay. It can be even a variance of 100, okay, meaning in that case the variance is very high, the data points are far away from each other, meaning in case of any change in the price of one, in change, either a drop or that is a drop or a gain, okay, we are expecting to have what? A very huge variance. If it is a drop, it can give us a drop of what? Of even around, let's say, 20%. And imagine you had invested on that around, let's say, 20 million. Can you imagine a loss of that is of 20% within let's say an hour? That is a very it is a very huge impact. Okay, so that's why we are saying that uh, variance can help us to do what? To understand the what? To understand the volatility of the maybe the currency which you are trying to um, to trade with, okay. So that's why it's always advisable, take maybe a stable currency, okay. Take as that is a stable currency. Like for example, if you want to trade, you can trade between maybe gold is always that is stable at some time, even if its fluctuations they are not that large, meaning the variance in prices they are not that large. So in case of loss, you won't be impacted largely, okay. But if now the world coin, okay, you can see the variance, it's going sometimes plus 40, sometimes it will go to plus 12, okay, meaning that's a drop, okay. So you can see that's kind of variance, okay, in terms of the prices, can bring an impact to your investment or to your trading if you were to trade, okay. So basically, take that aside, that was just an applicable example, okay. How you can try to learn all these things, okay. Yeah, so it is used by both analysts and traders to determine volatility and market security, okay. Then we have the square root of variance is the standard deviation, which helps us to determine consistency of investments return over a period of time, okay. Like for example, if the variance is high, you also expect the standard deviation to be high. If the variance is low, okay, or it's small, then you also expect the standard deviation to be what? To be small, because we know the standard deviation is the square root of variance. Okay, so they work together. So that's why we are saying it can help us determine the consistency of an investment's return. So it's better to have a small standard deviation or a small variance, okay, which will guide you to know how that is your what your if that is the period that your what investment will return. Okay, like for example, of course, let's assume maybe I'm investing on what can I which is the best example I can give. Like I'm investing in a low risk investment, okay? Meaning now, of course, for my case, I'm risk averse person, okay? I don't like taking risks blindly. I have to do some maths and see, will this investment maybe give me good returns, or and when, what is the return, that is the investment return period. Okay, does it mean it will return after 60 years when I'm already dead? No. I usually do what? I usually uh, check the what? The period of which this investment will what? Will return its initial capital. Okay? Yes. So you have to check those things. Okay? Even if it's math, you can do maths and see if the that is the return period makes sense. Okay? So basically what I'm trying to say here, standard deviation really helps us to see the consistency. Like for example, if this investment is giving me a cash flow of, let's say, 20,000, okay, how many years will it keep giving me the same what? The same return or the same cash flow, okay, for a period of time, or like how long, okay? Given we also have what? We also have other external factors. Like for example, for guys who maybe invested, let's assume invested in what? Let's say during. Can you give me that is a business which was really affected during the corona period? Let's say hospitality. Hospitality was highly impacted, like the hotels, because of the lockdown. People couldn't go and access those facilities. Okay, so meaning anyone who had invested, let's say, a year before COVID-19, it took time for him to recover, even after or even post what? Post COVID. Okay, so you can see those are some unseen factors which can what? Which can disrupt maybe the returns of your investment. Okay, so I'm assuming those factors, we are holding them constant. Then standard deviation can help us to see what? To see the consistency of the returns of your investment. All right. Any question before I can go to the standard deviation? In fact, this should be up there. Any question? Guys, if we are together up to that point, then by show of hands, thumbs up. I'm counting, I've seen less than 10 people. Alright, nice. So that's let's say more than 60% of the class has responded. So thank you. It means we are together. Okay. All right. Good. Let's continue. We have maybe some key takeaways for variance. So we are saying that variance is a measurement of the spread between numbers in a data set. Okay, investors use variance to see how much risk an investment carries, whether it will be profitable or not. Okay, so you can see investors use variance to see how much risk. So variance helps us to know the risk of the what of the in kind of investment we are going to make. Okay. Yes. If maybe you want to trade, like for let me just talk about the trading. Like if you want to trade, you also have to do some historical analysis of that maybe crypto which you are trying to do what, which you are trying to invest in. Okay, you can check maybe for the last maybe 2 years how has the prices been fluctuating. Okay, you can plot those different prices. You can even calculate their variance. If their variance is big, or that is it's a large value compared to another fairly performing that is uh, investment, then you have to know what you have now to choose. Of course, we know the higher the risks, the higher the gain. Okay, we know that because, but I usually say that is more of a gambling. The way they usually say, the higher the risk, the higher the gain. Okay, so for my case, I usually say that's gambling. I can't gamble with my money, so I have to. It's better I get a consistent cash flow for 5 years, okay, than losing maybe 100,000, okay, that is to invest on that is an asset which can give me 1 million or can give me a zero within one day. Okay, so it's all about diversification. Even if you are investing in shares, okay, make sure you have the that is of course if you want the highly that is the highly performing shares, maybe, or the company which has the highly performing shares, also consider to get shares from what, from another company which is not performing, it's fairly performing. I don't want to say which is performing badly, but I'm trying to say which is fairly performing. Okay, so that at least you can diversify your risks. Okay, yes, you can diversify your risk. So basically, investors use variance to see how much risk an investment carries and whether it will be profitable. Variance is also used to compare the relative performance of each asset in a portfolio to achieve the best what, asset allocation. So when you are doing your asset portfolio, or that is to get the best allocation, here you must apply that is the diversification. Okay, you cannot put all your eggs in one bucket, so you have to diversify. So in statistics, variance measures variability from the average of the mean, of the mean. It is calculated by taking the difference between each number in a data set and the mean. Okay, so you can see how we calculate what, how we calculate the variance. We calculate it by taking the difference between each that is the each number in a data set. Each number, I'm trying to call it xi's. Okay, because I know that I is taking a value from 1 2 3 up to what, up to n maybe. Okay, yes, so basically I'm saying that xi's, they are what, they are our different that is values, and we are trying to check that what is the distance between the xi and the what? And the mean of the xi's, that is the what? The x bar. Okay? Yes, that is from the first line. Okay? We are defining that it is calculated by by taking the difference between each number in the data set and the mean. So each number in this case, I'm calling it that is xi's. Okay? Then minus x bar. Our x bar, it's the mean. Okay? Right? Then squaring the difference to make them positive. So I'm squaring what? This difference. Okay? So I'm squaring this difference. All right? And then after squaring that difference, what else? And finally dividing the sum of the squares. You can see now we have talked about the sum of squares. So first of all, we have to do what? We have to sum the squares. So let me use the sum of squares, that is I is from 1 up to what? To n. Okay, so dividing the sum of these squared differences, okay, by the number of the what? Of values in the data set. So divide by the number of values in the data set. So in that case, if it was for sample mean, we'll use n minus 1. If it is for population mean, then we'll use what? Divide by n, and here it will be mu. Okay, so basically that's all about that is variance. Okay, let's go to standard deviation. Let me first of all hold on the explanations, or that is on the examples, so that we may finish these two slides. Okay, so the standard deviation is a statistics. It is a statistic that measures the dispersion of a dataset relative to its mean, and it's calculated as the square root of the variance. Okay, so the standard deviation is calculated as the square root of variance by determining each data point's deviation relative to the mean. Okay, yeah, so basically it gives us a relative value. Okay, that is of our variance. So if the data points are further from the mean, the higher the deviation, okay, within that data set. That's why we are saying, like, if your data points are that is far away from each other, you expect to get what? A higher variance. And a higher variance will mean a larger what? A larger value of the standard deviation. Okay? Yes. So basically that's what we are saying. That is, if the data points are further away from the what? From the mean, there is a higher deviation between the data sets. Therefore, the more spread out the data, the higher the what? The standard deviation. Okay? I hope that's clear. And that is the smaller, okay? The smaller the what? The standard deviation, okay? The closer the data points are to the what? To the mean. So of course the standard deviation measures the dispersion of the data set relative to the mean. It is calculated as the square root of the variance, and we say that standard deviation in finance is often used to measure that is of relative riskness of an asset. Okay, yes, so that's it about standard deviation. Yes, we have a question. Yes, Apollo. You have a question, or it's an addition? Maybe you are speaking on mute if you are speaking.
Sorry, Abu. Yeah. I just for clarification on on the data set. So on the formula for variance, it was you said you'll divide it by n minus 1 if
That
you're
is for
using
sample.
a sample
Correct.
population.
Correct.
But using the example that you had given for the 3,000 Maasais, so if you are using all the 3,000 Maasais, then it will be over n, capital N, which is over the total, the 3,000, right?
Yes.
Okay. That is what I wanted to clarify, whether if you're using the full population without picking a sample, then you use
The whole,
you have to
yes.
divide by the whole
Yes.
number. Okay.
Correct.
All right then. That's
All
fine.
right.
Thank you.
Okay, you're most welcome. All right. Another question? Okay. Silence means we are all good. So let's continue understanding the standard deviation. So the standard deviation is a statistical measurement in finance that when applied to the annual rate of return of an investment sheds the light on the what? The investment's historical volatility. You can see that. The standard deviation is a measurement of what? In finance that tries to show us the what, or that tries to give us light about the investment's historical what performance. Okay, if the that is if the investment was consistent to its performance, or its performance were what, or its returns were fluctuating. Okay, highly fluctuating. If it was consistent, the better. Okay, if it had some fluctuations, then you will need to think about that investment. Okay, yes. So basically it gives us that is all, it sheds some light on the historical volatility of that investment. Okay, so the greater the standard deviation of securities, the greater the variance between each price and the mean price. Okay, which shows a large price range, meaning in case of gain, you can gain highly or you can gain big time because of the larger price range. But in case of also a loss, you will lose what? You will lose high. Yeah, that is a big time as well. Okay. Yeah. So that's why we usually say that is the larger the deviation. Okay. The larger the deviation, the more risk of losing, and also the more like risk of losing big time is, and also that is the higher gains you would get, if you will get, if the investments goes that is in your favor. Okay. Yes, so that's all about standard variance and standard deviation. We shall check more when we will be doing what? When we will be doing what we call that is our practicals. Okay? Yes, we'll check and see that is how it will behave. Okay? Yes. So then, and next time or the next class, that is on Monday, because Monday it's when I see us finishing our first topic, because now in our first topic we are only remaining with covariance and correlation. Okay. So if Monday we can finish the two that is the two subtopic, then Tuesday will be our first practical class. Okay? Yes, Tuesday will be our first practical class. I will share the data sets over the weekend. Okay? Yes, so but basically you can go and that is check what is covariance. Okay? The difference between covariance and the what? And the correlation. Okay, you'll find that covariance is more of directional, correlation is more of strength and also direction. Okay, yeah, so you can go check on that. Come, please, I advise you even read ahead, so that maybe when I will be explaining what do you understand by the term variance? You are able to state without confusing it with what? With correlation. Okay? That's okay, guys? All right. Good, good. So if we are together up to that point, I can see we have some few minutes. I would like to, that is, to get some feedback from you over the chat. Okay, I just want to know if you've learned something new so far. Okay, how is the class for those? Is it 3 days? Okay, for those 3 days, and as well,